Welcome to the SNN Network Summer Virtual Event. I'm your host, Robert Kraft, and I'm very excited to introduce our next panel here today. This is a bit of a surprise because we didn't market who was actually going to be on here joining Ben Claremon for this panel. But again, this is titled The 10K Club, Best Overreactions to the Markets Right Now. Ben Claremon will be hosting this panel, and he'll be joined by 7 investors to discuss what their best overreactions are right now, and maybe some ideas and that support some of those theses. So with that, Ben, take it away.
Thanks, Bob. It's great to be here. The topic for today is the most contrarian takes on a post-COVID world. You're going to hear a number of panelists today, and so I'm just going to briefly read this safe harbor or aspects of it because there will be securities discussed during this conversation. So the opinions expressed herein are those of the panelists and are subject to change. This is not considered a recommendation to buy or sell a security. Please do your own research, and nothing that we say will or necessarily be profitable. So I'm going to do a quick overview, and then I'm going to pass it to the panelists so that we can start a really interesting discussion. And I'm also going to talk a little bit about the 10K Club because this is the first opportunity we've had to kind of share what we've built here in Southern California with the broader audience. So we're excited about that. I'm going to talk a little bit about myself and give some contact information. I've also asked the panelists to share their contact information as well, so that if you're interested in any of their ideas, you can contact them. On behalf of Bobby Kraft, I will do a shameless new podcast plug for the podcast that he and I have created. I'm going to talk a little bit about why the topic is so important. I'm going to introduce our panel, and then we're going to have our panel presentations and Q&A, and then we're going to move to closing thoughts. So welcome to this very special edition of the 10K Club, held in conjunction with Bobby Kraft and SNN. I'm just going to talk a little bit about what the 10K Club is because it often gets confused with a running club. That's not what it is. We're value investors at heart, and so this is all about stocks and securities. So this group literally started with 5 guys sitting on a couch in Santa Monica. It was always focused on investing, and it was just about the passion for investing and talking about securities and the process of investing. And now there's 160 people on the list, most of whom are all in Southern California. And back in the pre-COVID days, we used to meet in person every other month. And now, obviously, for very clear reasons, it's all virtual. And Bobby and I were talking about ways that we could maybe share this group with other people, and we said, why not open it up, since this is Zoom is a good medium for that. So what is it about? So basically, every meeting we pick a broader investment theme or topic to focus on. And sometimes it's about portfolio management, kind of high level stuff like position sizing or how concentrated to run a portfolio. Oftentimes it's more about thematic in the sense of we've talked about ESG investing, we've talked about inflation, we've talked about the differences in public and private investing. And so every time we pick a topic and then people weigh in, this is a little bit more of a formal presentation in the sense that the panelists will be giving their ideas and having Q&A as opposed to a total free-ranging conversation. So what are the goals of the 10K Club? Just from a high level, we like to discuss important topics that you might not talk about in the office setting. If you're a professional investor, you're probably not stepping back and talking about position sizing or broader implications of ESG and stuff like that. So this is just a chance for people to share their thoughts and in a kind of freer setting than maybe you feel like you have in the office. Make lifelong friends and find smart investors to bounce ideas off of. Also, if you happen to be starting a venture capital fund, maybe you could find some of your friends to invest in that has happened. There's been a lot of partnerships created and friendships created through this, which I think is really, for me as one of the creators of this, it's very, it's rewarding. But really, for the most part, is like when you find a group of people who are really passionate about investing, and just 9 to 5 or 9 to 7 just isn't enough. We got to talk about it more. So just a little bit about myself. I'm a portfolio manager at Cove Street Capital. I guess I'm also the founder or co-founder of the 10K Club. I was one of those 5 guys sitting on that couch. And obviously it's ballooned into something with a lot more people, I guess is the best way to say it. For any of you who used to follow the blogosphere in the early kind of 2010, 2011 period, I ran the blog called The Inoculated Investor. And I'm also the host of the new podcast, Compounders, The Anatomy of a Multi-Bagger. So if you have, if through this process you have any questions about the 10K Club, or you live in Southern California, you want to join the 10K Club, feel free to email me at bclaremon@Cove Street Capital. You can also follow me on Twitter. And then also, if you happen to be looking for a new investing related podcast to listen to, Bobby Kraft and I have just launched the Compounders podcast. We have 2 episodes out now. On the show, we interview public companies, CEOs, about how they've compounded capital over a long period of time. And we've had already 2 or 3 really good guests, and we're going to be releasing shows every Tuesday. So if you're interested, you can find the website here. So the topic for today is the most contrarian takes on a post-COVID world. So I'm going to take a step back and ask, why is this important? I think really, I'm not sure that we're going to know for years the full impact of the lockdowns and the associated behavioral, economic, and political changes that are going to come from all this. I think we're still kind of just trying to figure out what the new world's going to look like, because, you know, to think that this current environment and the way all of our lives have been transformed is not going to be lasting in some capacity, I think is a mistake. So if you think that the pre-pandemic status quo is what the world's going to look like, I think that's dangerous. And so as investors, we have to try to look around the corner. And so what I've asked is this distinguished group of panelists to present their most contrarian investing ideas as we emerge from COVID. And the way the structure of this conversation is going to be is that they're going to present the broader theme, and then they're going to talk about some investments that will either benefit or be hurt by this theme. And then we'll move into Q&A. We'll all kind of start the ball rolling with some questions, and then the other panelists will ask questions, and then other 10K Club members will be able to chime in on the chat box if they're interested. And so I'm going to let the panelists introduce themselves and talk a little bit about themselves if they like. But this is our group. We're going to start with Matt Peterson, move on to Josh Young, and then I'm going to take back the mic and talk for a little while. And then Alex Rubalcava is going to present, and then Jeff Mansell, Nick Nejad, my partner Andrew Leaf at Cove Street, and we're going to finish with Adam Gold. And so sorry, I almost just gave away my presentation. So I am going to hand the mic over to Matt Peterson.
Great, thank you, Ben, and thank you, Robert. My name is Matthew Peterson, and my firm is Peterson Capital Management, and we operate a long-term, highly concentrated value fund. We have a 10-year track record of over 19% annualized returns. So for this discussion, I was considering myself what constitutes a contrarian projection or prediction. Does it need to be rejecting some popular opinion, or can it just be something unique or some sort of market secret? And I don't believe that we need to find some opposing theory that's opposite of the herd mentality. Instead, what's more important is having a deeply personal and well understood bottom-up thesis. And sometimes that might differ from popular opinion, and at other times views might align. But the point is not to follow the crowd, but to stand apart from the crowd and make rational decisions based on data and facts. So with this characterization of contrarianism, I'll propose a couple situations that are incredibly promising at the moment. First, I propose that in a post-COVID world, market uncertainty and volatility will remain, and there will not be a green light that provides an all-clear investment signal and that says that it's time to invest. In fact, the time to invest is right now. So let's begin with this idea of not paying retail prices for stock. So this is a concept that we refer to as structured value, and it typically involves writing a cash secured put contract as a tool for equity ownership. And it reduces our purchase price for equity to below what retail investors pay for the exact same stock. And this is best explained by an example. So I've put together a slide here. Let's see if I have the ability to share. Great. So if I walk through an example here, most investors buy stock either through a market order or a limit order, but there's a better way that works extraordinarily well during times of uncertainty and volatility, which I expect to persist. So let's take a look at this example of a stock, hypothetical stock here that costs $100 on the NYSE. If we want to purchase the stock for $100, we don't do it through the New York Stock Exchange. Instead, we go to the Chicago Board of Exchange and we write a cash secured put option as a tool to own the equity. So many of you will recall that buying a call allows you to buy stock at a predetermined price in the future, and buying a put allows you to sell stock at a predetermined price in the future. So if we create and sell a put to a counterpart who is now the buyer, it allows them to sell us their stock, and we want the stock, and they pay us for the right to sell us their stock. So instead of buying the stock for 100 through the NYSE, we might request $25 for our commitment to buy their shares for 100 over the next year. And then there's a binomial outcome. Either one, the shares decline below 100 and we get put the shares for a net cost of 75, which is the 100 that we committed to pay less the $25 that we were paid for the contract up front. Or alternatively, if the stock price doesn't go below 100 in the market, and then we don't get the shares. And this means that we earn and keep the $25 premium on $75 of collateral and earn 33% in a year. So, is this approach really contrarian? Not necessarily contrarian, but it is very unique. And today it provides an enormous advantage that is very profitable. So what I'd like to show you is how this would apply to a specific example. And this is a highly contrarian position that we own. It's because it's a small special situation that is really misunderstood. SRG is it's a real estate investment trust that includes 154 ex-Sears mall anchors and standalone stores that were spun off prior to the Sears bankruptcy. So these legacy properties are in ideal locations like Santa Monica, California, Redmond, Washington, downtown Honolulu, Miami, Florida. And, having completed a property by property analysis of all 154, I'm very well aware of the value, but there's a really logical way to think about this business. The properties here, as I'm showing here, they're basically being repurposed into mixed-use space that are in 3 distinct phases of development. So first, we have properties that are developed with paying tenants. So this is your triple net tenants. They have 91 million in NOI in this category, and using a conservative 7% cap rate versus an industry standard, which is basically sub 5 at this point. These properties are conservatively worth 1.3 billion. Okay, next, properties being developed. So some of these properties that are in a development stage have signed tenants waiting to move in when the project completes, and others are available to be rented upon completion. So this total between the two, conservative value at, again, a 7% cap rate, is 1.65 billion. And finally, there's a third group of about 15 million square feet of property that remains and can be sold or can be used in future development projects. So if they are all sold for a conservative $70 per square foot, the properties have a value of 1 billion. So we can add up all these parts. Combined with cash, debt, CapEx, including this JV, a few JV efforts, they have a 2 billion enterprise value. You can see right there at the bottom in gray. If we fully dilute the shares for some special units that are owned by Eddie Lampert, the price per share should be over $35 per share when the projects from the second bucket are all complete by 2025. And that price might be much higher. It's a very conservative price. So the shares today are around 15, implying a 23% annualized return on this business through 2025. Actually, a conservative 23%. And don't forget, we're in a zero interest rate environment. But again, that highly satisfactory return is not all. We now overlay the structured value approach to the shares that I mentioned at the beginning. So when we agreed to buy these shares for 15 through January of 2023, 17 months through the Chicago Board of Exchange, we can sell a cash secured put for a price or premium of $4.50. So we're committing to buy them for 15 and we can pick up $4.50. So what are the possible outcomes after selling this contract? If shares decline below 15, our counterpart will put the shares to us for a net cost of $10.50. 15 that we commit minus the $4.50 that was paid to us. So this is 30% below the cost in the New York Stock Exchange today. Further, when shares reach the expected $35 stock price, we now earn over 3x our purchase price in these 4 years. So that becomes a staggering 35% annualized compound return instead of the previous 23% return we mentioned for the stock. So, and then what happens if shares do not decline below 15? Then we simply earn and keep the $4.50 premium that was paid on our $10.50 in collateral over 17 months. So that gives us an astonishing 42% gain. So this is a very unique sort of situation and environment that we're in, and I really expect this environment to persist for some time. And finally, it's worth mentioning because everybody will want to know about the risk. Finally, there's a huge embedded margin of safety that's notable for two reasons. First, because the firm's backed with hard real estate assets that are worth more than the market price today. But second, it's through the purchase method, through the structured value method. So if we're wrong about the valuation, because we are only paying $10.50 net for the stock, the same stock that costs $15 to a retail investor, the stock price can decline a full 30% and we still make money. So that decline is very unlikely, but should it happen, the portfolio is just fine. So, you don't need to follow all the math here. Really, I think what's worth recognizing is that our structured value strategy involves using puts as a tool to purchase stock for below market prices. And despite COVID reopening, the uncertainty and volatility in today's markets will persist, making these contracts expensive and this approach extraordinarily profitable. So thank you all very much. To learn more, you can visit our website. Our website is petersonfunds.com. We have a YouTube channel where you can see many more examples of this type of analysis. So, please search Peterson Capital Management on YouTube. I am happy to take questions.
Matt, thanks a lot. I've always been fascinated by the way that you enter into positions. So one question I have on that front. So if you have the opportunity to buy through this method to create a larger margin of safety for yourself. And so, but I wonder if in some situations, the situations that have this level of opportunity where you can get $4.50 on a $15 stock, there's got to be some kind of binary or secular risk. The market is perceiving some level of risk. So I'm trying to get a sense of how you think internally about avoiding taking too much business risk, essentially just because you get this margin of safety. You're almost so focused on the value side and how cheaply you can get it. You maybe, just don't pay enough attention to the business risk. How do you intellectually think about that?
Yeah, that's a great question, Ben. So first of all, it's about position sizing, and we run a concentrated portfolio, and I think a lot of people on the panel run concentrated portfolios, but it's really about sizing the notional exposure properly. So when we're looking at, say we want $1 million in exposure, we're actually, taking our net cost being 15, or our total cost being $15 a share, and calculating how many shares we want to expose ourselves to from that capacity. So And where I thought you were actually going is, when there's this potential upside, and I think you were kind of alluding to this, there's there's got to be a lot of uncertainty, because what's happening is there's a lot of vega. So when you get a lot of volatility and there's a lot of vega in the price, there's usually a lot of uncertainty, but it doesn't necessarily mean it's risky. I think there's a difference between uncertainty and risk, and the market kind of treats them in a similar fashion. So I think as we see this story play out, and believe me, you dive down, the narrative is very troublesome for all sorts of reasons. So it makes sense that on the surface it looks uncertain, but when you go through a property by property analysis and understand exactly what's transforming and happening, it becomes pretty clear. And I think there's really an asymmetry in the outcome. So the bigger challenge is that when you sell a put contract like this, write a put contract, you actually are taking the risk that you miss the upside. So if Seritage were to move rapidly within the next 12 months from 15 to say 60, we'd be capturing our $4.50 on collateral of $10.50. It's a 42% return, but we'd miss going 4x with the stock, and that is a bigger concern when you start to really understand the business and the potential.
Great. Other panelists, I'd love to hear any questions that you have for Matt.
I'll throw one out. So of the 154 properties, not every single one of them will have, probably redevelopment costs factored in. So how do you figure sort of across all of them, what percentage may not exist, and what happens if some of those defaults or close? How many will actually get through the redevelopment? How do you sort of scope the entirety of it?
Yeah, thanks, Adam. That's a great question. So first of all, there's out of the 154, there's already a number of them, a few dozen of them that are developed, redeveloped, they're complete, and they're rented out. And so I just turn back to this slide here, if it's still sharing. That's our bucket, our first bucket. They lay out, management lays out the details of how these projects are moving along. So they have this term signed but not open. So they have all sorts of development in progress with costs laid out, and they have basically 65 million that are expected to have NOI of 65 million to have coming in within the next 12 months as projects open. And then the second bucket here is a pretty conservative estimate, but it's we modeled it out internally. So we're basically looking at what the average costs are and how things will look, and we're modeling out, well, for this to actually take place, it's going to require, and you can see down at the bottom, there's quite a bit of CapEx. So that's a number that we've come up with to develop the remaining bucket here. One thing that I will point out that's very interesting is that, Adam, this management team is extremely conscious of sort of opportunity costs of capital. And so what they are doing is sort of recycling this real estate portfolio. So these non-core assets are literally potentially up for sale, because when they get an offer or they sell, and they typically sell for over $100 a square foot, but when they do sell them, they then repurpose that cash into developing new projects in their pipeline. And they're only putting capital to work when they have high teens or 20 expected IRRs on that capital. So I'm actually very confident this is a really strong management team. And if you dig deeper, you'll realize that Warren Buffett owns 8% of the stock. Berkshire Hathaway's provided 100% of the debt. There are some really strong co-shareholders in this business, and so they tend to be thinking along the lines of value and opportunity costs, and so I'm pretty confident with that second number in bucket 2. And then in bucket 3, we're actually not really calculating any development. And the only way that they would develop it is if they could get more value through redevelopment than if they sold it. So we're sort of saying fire sale, liquidation, This includes a number of this 15 million square feet includes a number of great properties. It also includes, this is an average, it also includes some not so great properties. There are some that you wouldn't get $70 a square foot for. But the average is 70, and that's a pretty conservative number. So we don't have to figure out any development costs for these. I'm confident that if they develop them, it would be because the development value would be higher than the cost of a sale.
All right, Matt, thank you so much for talking about your interesting strategy and the way you approach investing. That was great. So now we're going to pass the ball along to Josh Young.
Great. Thanks, Ben. Thanks, guys, for doing this. I'm going to talk about, here, let's see if I can get this open, a extremely unusual area of the market that is, I think, very poorly understood, and it's the ethane market. And so I liked Matt's background. I thought that was a good way to explain kind of the relevance. I guess just for a second, what Bison does, we invest in oil and gas stocks, and that's kind of where I'm focused. And none of these are recommendations, and I own stock in the one company I'm going to talk about later. And ethane is really interesting, and I think is particularly relevant because it's the base material. It's the source for a number of the single-use plastics and face masks and so on that are used now in this post-COVID world. And between ethane and propane and butane, that NGL mix is actually very important in the world. People have tried to move away from it and have found that pandemics and other sorts of things really kind of push consumption of the end products. And it's something that no one really is paying attention to, partly because pricing was so terrible for so long. So I'm going to show a few slides and try to keep this really short. Ethane has been at a low price for a long time in a fairly tight range, and it's bumping up on the top. That's what you see on the chart on the right. On the left, you see that that's happening despite ethane recovery actually being at a multi-year high, and ethane production kind of continuing to rise. So it's pretty unusual for a commodity to be rising in production, but for the price also to be rising. And so it's kind of this obvious question, and it's something that I think is really interesting. And it's especially exciting because drilling activity in the US is not rebounding as much as oil and natural gas prices have been rebounding. So this rebound in ethane recovery and ethane production may actually not continue. Ethane production might be a little more limited and require much higher prices. And so where you see that 5-year range where ethane has historically gone way higher than the current 34 or so cents that it's at per gallon, I mean, it could go very easily to 60 cents a gallon, which would only be, I think it works out to be the equivalent of less than $30 a barrel. And another use for it is to export it so it can get processed in Asia. There's this whole kind of ESG movement, which is a joke, in my opinion, for several reasons, one of which is that we just seem to export our pollution to China. And so China is happy to receive our ethane and then turn it into plastic and then ship the plastic back to us and then sell it. And then we can all pretend like whatever company it is that's providing that, whether it's Apple or Berkshire Hathaway or whatever, should have a high ESG rating. So exports are rising. There's actually a bunch of export capacity that's come online somewhat recently. There's a new kind of tanker that's transporting almost half of the ethane out of the US now, and there's a number of those tankers coming online shortly as well. And so this is a very kind of strong up and to the right trend. Again, this is kind of a niche that people don't really understand. And this is very mispriced, as we saw in the last slide, at roughly $14 a barrel versus oil at close to $70 a barrel. So this is something that can get used for some of the same things as refinery feedstock, but that costs way less and is actually much more useful from a plastic perspective. There's giant projects also that are in the works right now that are beneficial for ethane for two reasons. One, they will use a lot of natural gas to power them. And so they'll actually be beneficial for natural gas demand. They're so big that they actually use a measurable amount of gas versus the total gas supply in North America. The other big thing about these, and these are just 4 examples, I pulled them off of NES Firecraft's website. There's a lot of these that are going on right now, but these are coming on now or coming on over the next year. As these things come on, they're going to start consuming a bunch of that ethane that we saw that's been growing. If ethane production doesn't grow more, which isn't happening right now, you kind of like need it to grow more just to supply these plants. And these tell you, and the huge cost associated with them, and the real producers, Shell, Exxon, so on, there's going to be a kind of run on ethane, and pricing is going to go from extreme lows to potentially multi-year or even multi-decade highs, and they may actually stay there for some time because ethane is a relatively small component of the production stream. So there's room for this to run and to run in scale. So a company I own stock in, and a way that I'm getting exposure to this, is Sandridge Energy. I'm not going to walk through kind of the whole thesis or give kind of as much kind of color as others might. I've talked about this investment extensively, but this is one of the first times I'm really kind of showing the logic of the ethane component of this business. So Sandridge has, at last I checked, 0 research analysts that cover it. They just beat earnings and their stock went up a lot. It's kind of funny, they beat their own guidance. You can see the guidance on the bottom, and in terms of what their differentials were expected. And again, this is as a percentage of hub pricing. It's not as a overall basis. So this isn't like a, hey, oil's going up or natural gas is going up. This is they're going to get a better price for their specific product in the specific area they're in because of local demand for those specific things. And for them, their NGL pricing is the thing that they beat on by the most. They generated 45% better pricing in Q1 than they had guided to as of the end of Q4. And that's even better now. They don't have their second quarter presentation out. I literally just pulled this off their first quarter one. And in Q3 so far, with ethane having run up even more, this is an even bigger percentage. And there's they're getting closer to, I think, 50% or 40% of NGL pricing versus oil, which is huge. The way you know that Sandridge is producing a lot of NGLs is that ethane is the lowest priced NGL, and they were guiding to 20% recoveries. I mean, like, I've double checked this in various different ways, but they are one of the highest percentage ethane producers of any of the producers of ethane in the US versus their total stream. They traded a low multiple, so that helps. And because they had such a low margin, this uplift provides tremendous cash flow expansion and margin expansion. And for them in particular versus many other producers, and they don't have any hedges, but because they have this margin expansion going from a very low base allows for them to generate kind of a bunch of extra cash flow. Sandridge had been an investment that I had made because improving local realized pricing and improving natural gas pricing was allowing the stock to re-rate. And there's kind of this incredible thing. So I pulled this off of an old presentation. The stock has now doubled again almost from where it was as of June 30th. And it's in the process, it's like people just don't want to do the work. They see a stock chart that's gone up. It's kind of similar to Matt's thing with the selling puts. People like have this kind of negative bias against it. People don't like to buy stocks that have gone up. But this thing at like 2 times cash flow, providing a product that is seeing expanding margins with huge demand coming online right now, it's pretty compelling. And then I guess just one last thought on this. As ethane is pulled out, I think that was the last slide, yeah. As ethane is pulled out of the gas stream, ethane generates just under 1,700 BTUs of energy when it's burned, of heat when it's burned, and natural gas generates just under 1,100. So there's almost 2x energy uplift in ethane versus natural gas. If you're burning gas that has ethane blended, it might have 1,200 versus if you burn gas without ethane blended, it has less than 1,100. So you get a almost 10% reduction in your heat capacity in your gas if you're burning gas without ethane. Well, if you start pulling a whole bunch of ethane out of the gas supply, which we're about to do, as we saw in that earlier chart with like $30 billion of projects that Shell Exxon and Saudi Aramco and so on are doing, you're going to end up with a much leaner gas stream, which means you're going to need more natural gas, which means higher natural gas prices, which means a higher price for ethane. And this thing could be circular to some extent, and you're starting from a base that's ludicrously low, $14 a barrel, for a product that's actually pretty competitive for certain portions of the refined product stream. So that's the variant view. Again, you kind of win several different ways, and there's stocks that are trading at like 2x cash flow with giant free cash flow yields and net cash and a buyback in place. There's others that are similar. This one, I think, has the most exposure. And so that's how I'm exposing things post-COVID.
Josh, thanks a lot. My guess is that most of the people listening here haven't ever really come across ethane. And so clearly like a well-researched and contrarian perception on the market. So here's my question for you. Do you look at this as like just a short-term play on ethane and a recovery there? Or are there, given the investment that you pointed out that's going on, is this, could you see holding Sandridge for years as these projects come online and there's more juice than just like a kind of a short-term recovery?
I think it depends on the kind of path of this price improvement. So there is a possibility that these just enormous, essentially unprecedented projects come online at the same time as some of these additional export facilities come online, at the same time as some of these tankers come online. And there's just such a big squeeze that ethane prices go from like 14 to like 70 and Sandridge goes to like $50 a share or something. So in that sort of circumstance, I'm running because I'll get my like 30 years of return or 20 years of return in a year, and that's great, and you get out. I don't think that's really how it'll play out. I think that these things always take longer and cost more and are more complex and so on. And they do have a buyback in place. And if you look at kind of this long-term trend, the long-term trends are really attractive, and the base of price has been really stable for a really long time. And so I think there's room for this to grind up. I mean, if you look at like a historical housing chart before this housing bubble in the last 30 years, if you look at historical costs of other commodities, you see these sorts of things where they're like boring and stable, or like salt, for example, right? Boring and stable, and then they get not boring and not stable. And sometimes they re-rate at much higher prices. I don't know where the ceiling is there, but yeah, this could grind higher, or it could kind of rip higher, like way higher. This was one, provider, obviously they think it's going, they're kind of implying it's going to like 60-ish cents, which it would be a double in 3 months, which would probably imply it a double or so for Sandridge, maybe more as their cash flow expands. But it's really hard to know the future. It's just like helpful to have a whole bunch of things that are like already working or have already worked and have just no one familiar with it, basically no speculative interest in the futures, no ownership of the stock. And like, I mean, I've talked about Sandridge a lot recently, and people are like calling me dumb for like not selling a cyclical stock after it's up. And it's like, okay, cool, maybe. Like, if I'm dumb and it's at 2x cash flow and there's this thing that's sending the cash flow up, maybe I want to still own it until people think I'm brilliant for it, and then I need to run and sell everything.
Josh, how quickly can other drillers ramp up NGL production?
Not very quickly. So there's like, and that is a really good question, Alex, right? Because there is this history of companies getting good pricing and then rushing. I probably should have put a slide in. Propane prices are at close to $60 a barrel right now, and they actually were at under 20 last year. So it's kind of like the success case. I just kind of didn't want to muddy, because they are kind of similar but different. I didn't want to like muddy the waters too much. So propane is driving economics right now a lot on NGL production, because even though ethane is a little more common, propane prices have moved a lot. And so far, even with $60 a barrel propane, where propane was, like 18 or whatever a year ago, you haven't seen a material increase in the rig count in areas that are NGL rich. So it could happen, but also the CEOs of those companies are under tremendous pressure from their investors. There's the ESG set that are trying to prevent drilling of any kind. And then there's the people that like to make money who would prefer their producers to spend less than their cash flow and to use proceeds to their free cash flow to buy back stock and pay dividends. And so that's kind of the trend, where the trend was over investment for a long amount of time.
Josh, that was great. Thank you so much. Very interesting and truly, something outside of most of our scope. So thanks for that.
Absolutely.
I'm going to take the mic back for my presentation, and then I'm going to pass it to Alex. So I've got 4 themes that I'm going to talk about, and I'm going to briefly mention some securities. Josh and Matt really went into 2 securities specifically. I'm going to go more high level themes and then mention some stocks that I think will benefit from that. So the first theme is the empire will strike back. And I'm stealing this idea from Carl Kawaja, who works for Capital Group. And in an interview recently on Patrick O'Shaughnessy's Invest Like the Best, he talked about this concept of the empire will strike back. And really the big idea is that there are some incumbent companies out there that will be able to reinvent themselves and prosper in the future. Not all incumbents are going to be disrupted by digital companies. Not every market can be disrupted by an app. People have this idea that like every market is the Uber taxi market, where, Ubers came in with a lower price and a much more convenient offering, and they totally disintermediated taxis. I don't think that those same dynamics will occur everywhere. So the truth from our perspective is that even if there are low barriers to entry in certain industries, there can be still meaningful barriers to share gain. And whether those are network effects or just inherent scale or regulatory burdens, or even the benefits of having a hybrid model where you're both digital and physical, we think that some of the incumbents have a reason to exist and a reason to even succeed in a kind of a more digital world. So 2 very, very contrarian stocks that I think benefit from that. One is Western Union, which, whenever I bring that up with anybody, I get eye rolls and people, literally like, I can't believe you're talking about this stock. But, very quietly, they have $1 billion digital only business, which is, by the way, way bigger than Wise, which just came public at a much, much larger valuation. So they have a bigger digital business than Wise does. I think hybrid wins. It's just like in other things, it's not physical or digital, it's both, because there will be different customer cases and different uses for every base. And I think Western Union has the best compliance infrastructure, the best network in the world. And in the meantime, as they build their digital business, they're going to generate a huge amount of cash. And the truth of the matter is, in the remittance business, sending money from here to Mexico or here to India, or from India to Egypt, right? The big banks are the losers. They're the most expensive. They're the least efficient. And so even if the digital startups continue to gain share, I think Western Union can continue to mop up share from the banks as well. So that's one where everyone thinks Western Union's being disintermediated. I think their digital plus physical backbone is actually a benefit. The other one is car auction services, Sugar Car. We own both of these stocks, by the way. This is another one. Physical car auctions are being disrupted to some degree by digital players. Car actually during 2020 went all in on digital. There's a huge total addressable market for them in what's called the dealer-to-dealer market. They've traditionally been more on the commercial market, but if you're a dealer in Santa Monica and you want to sell to a dealer in Pasadena, Car really didn't have a very large percentage of that world. And digitally, that world is being opened up because you can do it on a computer, you can do it on an app. And the competitor who's come into the market is called ACV Auctions. The company has a market cap way larger than Cars right now, or larger than Cars right now. And they were the first mover, but I think the things that Car has done and the benefits they have from being incumbent are going to help them win. And so those are 2 ways to play the theme of that there are some incumbents that are going to win, and that not every company can be disrupted by digital players. The next theme is that inflation is a big topic these days, and the question is it transitory or is it lasting? I don't know the answer to that. I really think that there's a lot of industries that will give back pricing as raw materials drop. And from a broader perspective, I think what happens to wages is more meaningful anyway. I don't think I'd want to be a restaurant franchisee right now, given what's going on in the wage world. And you know, as Alex knows all too well, automation is likely a solution to that. But here's what I do have conviction in. We follow a lot of really concentrated industries that operate in kind of duopolies or oligopolies. And my sense is that consolidated industries are going to keep the pricing they took. So what that means is we're going to see like a one-time 8 to 15% increase in pricing, and then they'll have moderate pricing power afterwards, just because their customers really have limited mechanisms to reduce pricing. So, you know, like you could argue that a lot of these companies are over earning right now, you know, especially as raw material costs are starting to rise, and that they're going to be hurt. But I think as things settle in, you know, a lot of these companies are going to have, you know, even higher margins than they did previously and better, and then just continue with their traditional pricing power. So an example, we own Axalta, which is in the coatings industry. It's a very consolidated world, and there's just, you know, the coatings world has just really become much more concentrated. And aside from in the auto world, where the auto OEMs like Toyota can say, yeah, I know your pricing's high now, but as raw materials come lower, you're going to lower your prices. There aren't a lot of mechanisms for their other customers to take pricing back. So I think Axalta is a company that will benefit from the auto recovery, which we will see eventually as we make more cars and the chips come back, and then increase pricing power and higher margins. And then I stole this quote. We own this company called Mueller Water. Mueller operates in duopolies or in oligopolies in most of its markets. So if you see a fire hydrant in a municipality that has Mueller products, you know they can have up to 60% share in a specific municipality. And so I just want to read this quote because I think it really captures what I'm trying to say so this is their CEO said regarding inflationary periods. The thing I'd like to make sure that you understand, though, is in the past, these have actually been positive events. Yes, we have a little short-term pain, but when the commodities market settle down, as long as it's a gentle settling, we would expect that all price we get through these inflationary periods to retain in the future as we want to set a new baseline. So I just think, you know, there are just a lot of companies, especially US companies industries have consolidated to some degree, which is such a large degree that we're just not going to see a lot of, you know, price take back from their customers. Just quickly on, you know, the US consumer, you know, I think everyone's trying to figure out what the run rate, like how much people are gonna be able to spend on things, and, you know, what is really true consumer demand look like, because whether it's stimulus or the moratoriums on evictions and repossessions, or just people shifting what they're spending on, it's really hard to know what, like, you know, the true run rate demand for certain products is. I guess what I'll say is I think you should be really careful about companies that have benefited from COVID lockdowns and are achieving results that are like way above 2019 levels. And I think you should be extra careful if you're paying peak multiples, because those cash flows may not be sustainable. And so just quickly, Scott's Miracle-Gro, it's a company we've owned in the past. We don't own it now. It's actually a great company, but it's really the poster child for this dynamic. So if you look at their US consumer business, it did about a little less than 2.3 billion in revenue in fiscal 2019, which was basically flat with 2016. So basically 3 years of no growth. Then it was up 23% in 20, and this year they're expecting another 7 to 9% growth. So that is way, way over the, you know, if 2019 was a base, it's way, way over that. And the question is it sustainable? And I don't know the answer to that, but I do know that the stock trades at basically elevated multiples relative to its past. And so if you're paying kind of an elevated multiple for a company that's over earning, I think that's a really bad recipe for success, you know, at least in the short run. I mean, that you may own it and you trim it, and there's different ways to play it, but I just think I just don't see enough commentary in the market about like, what does a baseline look for these companies, and what does it look like when we eventually move out of lockdown and start spending on other things? And so two other industries that I think are highly at risk of this are the mattress industry, which have done, you know, Sleep Number and Tempur-Pedic have done really, really well during this period. I just don't know how many people can afford a $4,000 mattress. And if you question where does that $4,000 number come from, that's like the average total price that they sell mattresses for, these companies, when you include all of the things they sell along with it. Also home improvement, this is kind of an obvious one. Sherwin-Williams and Home Depot are great companies, But I mean, when you're comping 20% on 20% when you're Home Depot, I just don't know what the true earnings power is. And as in someone who invests in consumer stocks, I think you have to be really careful of owning these companies and assuming that the baseline is anything like what the current situation is. And so one broader theme, this is sorry to end on a somber note, but COVID was not an equalizer of any sort. What it is it exacerbated social and economic issues that exist in the world. And I think there are a lot of people that are unhappy about their current economic situation and circumstances. And that's true in the US, it's true outside the US. So I just could think we could see an elevated period of political unrest in countries that are unfortunately pushed over the edge by COVID. And I think, we invest in Latin America. So this is something we're very cognizant of, but, I think emerging markets could be a little harder. And I just don't know that we really understand the lasting financial impact of COVID. Stimulus and central bank intervention have really created this suspended animation. And so, it's scary, but I really think that we're in a lot of countries are in a tough situation that are only going to be exacerbated by climate change and climate migration. So those are my four themes. Happy to take a question before I pass along to Alex.
One quick question, just how do you play the unequal or people being unhappy after COVID thing?
It's probably what you avoid, right? I think you have to be really careful about the companies you invest in, where their core end markets are. I think, as I said, Latin America, for example, is one of those. Excuse me. Latin America is a place where I'd be a little worried, but I don't really know, Josh, to be honest with you. Alex, you ready to go?
I am ready. Let's share the screen here. All right, so my firm is Stage Venture Partners. I am an investor in enterprise software startups at the cutting edge of science and technology in big industries. We like product risk, we like technology risk, and we do not like competition risk. And so I'm going to talk about one of the areas that my firm invests in, robotics, and why robotics, I think, are poised to have a market and an opportunity unlike anything that has happened before in the robotics industry. Part of the reason that I think robotics are going to be a big opportunity going forward is because, unlike people, robots never quit. And we're going to talk about the environment for quitting and the labor environment that a lot of industries are facing right now due to trends that existed before COVID and that have been put on steroids due to COVID. So the theme that I will be talking about today is that low-skilled labor was, for 40 years or so, up until the middle of last decade, fungible, abundant, and cheap, and it is none of those things anymore. It is scarce, abundant, and scarce, expensive, and non-interchangeable. That is going to force a lot of industries that were built on the assumption of cheap labor to substitute capital for labor, and the form of capital that they are going to use as a substitute is technology generally, and in a lot of applications, it's going to be robotics. And we're going to highlight one of my portfolio companies, Gray Matter Robotics, as a company that exemplifies this solution. Unlike everybody else here, I invest in true startups at the seed stage, companies that are very young. So mostly I'm going to be talking about a private company here. However, at the end, I'll discuss a few public companies that those of you who spend time evaluating companies can use as sort of thematic ideas to explore this, and where you can go research some of these kinds of ideas. But I'm not an investor in public companies for my day job, so this is not as well researched on the public side as you would get from some of the other guys in this presentation. So let's talk about quitting. Let's talk about how the labor market looks today. I like looking at Fred data from the Federal Reserve of St. Louis to look at a lot of the trends in the labor market. This is job openings in non-farm jobs. It's at an all-time high. People are quitting their jobs as well. We're going to take a look at that in a moment. Why is it not scrolling? Oh, so let's look at quits for accommodation and food services. Some of my friends on Twitter like to call this the McJobs quit rate, because these are the lowest paid workers, the people with generally the fewest choices in the labor market. And we now have this economic series at the highest rate of quitting ever observed, except for a tiny little blip 20 years ago. And I suspect we're going to blow through that blip pretty soon, and that anyone who needs a lot of workers is going to be in a world of hurt for a long period of time. This applies no matter what kind of an industry you're looking at. This chart basically divides the wages earned by what we consider to be the good jobs in blue collar work, manufacturing, industrial kind of work, the kind of jobs that, you know, we had a lot more of in our country, by what were the lower skill jobs, which is to say hospitality, accommodations, general service jobs. And it used to be that you got paid about half what you did to work in a manufacturing job. So if you made $10 an hour, if you made $20 an hour working in a factory, you might make $11 an hour working in the cafe that was a block away from the factory. Today, that ratio is collapsing. And of course, you can see that that was a trend that was on its way before COVID. And then after the disruptions of COVID, where that reversed the trend a little bit, it has now bounced back in a really material way. And I believe that because of the demographic changes that are happening in this country, that's going to be permanent. The huge amount of census data was just dropped today, and I haven't had the chance to review that in any great detail, but we all know the headlines. We all know the headlines that immigration is at generationally low levels. We all know that population growth is at generationally low levels. And we all know, of course, that the composition of the workforce is changing. When I talk about the composition of the workforce changing, I think one of the most important things that we have to understand is that we are facing what, from a social perspective, is a good thing, but from individual business positions is a bad thing. And that is, we're running out of high school dropouts. We're running out of people who didn't go to college. We are running out of the kind of labor that powers a lot of businesses in America. And this college completion rate is about the most steady economic series you will ever see. As you can see, there's basically no variability there. Every decade, there are more people age 25 or older who have completed college than there were in the decade before. That slope, as you can see, is going to exceed 40%. We're going to be past 40% sometime in this decade. And that is going to fundamentally change the workforce of this country, because if you have a college degree, you are not likely to be working a job in a factory. You are not likely to be a barista at Starbucks. You are not likely to be providing home health care services at the prevailing wage in home health care today. Every business that is built on that assumption that there's a fungible pool of labor for those kind of work is going to break. Every single one is going to break. And the way that they get rebuilt is with automation. So let's talk about automation, and let's talk about one of my portfolio companies, Gray Matter Robotics. Gray Matter Robotics is based here in Los Angeles, California. It is founded by 3 PhDs, Aryan Kabir, Gural Shah, and SK Gupta, who have published 65 papers in leading journals like IEEE journals and whatnot about the way that they can now apply robots to a unique market and a unique application that no other company on planet Earth is able to even attempt right now. And that is to have robots sanding, grinding, deburring, and painting large industrial parts. So that part that you see in the photo at the bottom left, is a body panel for, I believe, a bus or a truck or something else. It's made out of carbon fiber composites, and it needs its surface treated 4 or 5 different times. It needs to be deburred, it needs to be sanded, it needs to be painted, and then it needs to have the surface finally treated before it's ready to go and be installed on a truck or on a bus. The performance standards here are very exacting. The type of person who does this job is generally a middle-aged to slightly older male who did not go to college and who is making, depending on the geography, anywhere from $25 fully loaded to $50 to $100 fully loaded. Those high numbers are in very specialized job markets where labor is very low, like the places in the Midwest, where recreational vehicles and the like are manufactured. Gray matter has pioneered the opportunity and the ability to take existing robotic arms made by third-party OEMs and to train them to scan a part that is complex, that has curves, that has indentations, that has holes, and understand what are the performance characteristics that are required and automatically sand that to a level of precision that is required by a manufacturer or an OEM. And what I think that everybody here has to understand is that as those 45-year-old or 50-year-old guys age out of the market, their kids are not going to be taking these jobs. Their kids are going to be working in an office, doing social media strategy for a growing company. Their kids are going to be teaching yoga classes. They're going to be doing different kinds of things. And yet we still need these parts. We still need this manufactured output. And we're going to be transitioning that kind of labor into the work of robots. One of the interesting things that comes up when you do that, of course, is that you dramatically reduce the cost. You are probably going to increase the amount of supply that is produced because the marginal costs are going to be materially lowered, and we're going to find new uses for this kind of stuff that we did not before. There are a number of public companies that operate in the world of industrial robots. I've listed a few here. A number of them are publicly traded in Japan, and then a few others are recent SPACs here in the United States. With that, I'll leave it, and I'll be happy to take questions.
I'll throw it out, Alex. CapEx versus OpEx. I always find this is a big question. Understanding humans are paid hourly, no CapEx versus a robot is purchased, right? So how do you think about the sort of the break-even point, or in terms of the amount of utilization you need?
Yeah, so most of the robotics companies that are venture-backed today, including Gray Matter and some of my other portfolio companies in the space, offer customers a choice. You can either purchase the robot and then have a software subscription on top of that. And that ends up actually looking almost exactly like what software used to be with SaaS, where you had a license fee plus a maintenance fee. And so it's kind of a little bit of a back to the future thing in terms of the way the unit economics work. Generally, larger companies, larger customers like to procure in that way because they can afford it. Smaller customers generally prefer a more SaaS type of product where they're literally just leasing a robot. And in the industry, we call that robotics as a service, RaaS. And all the companies have the ability to go to market in whichever one of those formats that a customer prefers.
Alex, this has been great. Thank you so much. This is, you really have your nose on what's going on in the startup world, and obviously have done a lot of research too about the kind of the macro things that are helping your companies. That's great. Let's move on into Jeff Mansell. Jeff, you ready?
I am ready, Ben.
All right.
That's first of all, thanks Ben and Bobby for putting this all together. This is it's already been a really interesting and good learning experience. All these guys, are very knowledgeable in the Josh and Alex. That was a lot of good information, especially in some fields that maybe us more generalist investors don't have feel like tourists in, So I was going to talk about, first, my ideas about, what is Contrarian right now, right? And then talk about a few securities that I feel fit the criteria. So first, my investing philosophy, one of the guiding parts of my investing philosophy is people don't change. Their wants and needs don't change. The tools that they use to accomplish those wants and needs and the culture that they use to organize those efforts change, right? So investment opportunities arise when the market either prices in people changing or doesn't price in the profitability or the adoption level of a new tool, right? In order to, good example over the last 10 years is people love to be entertained. So TV was a profit machine for many years, but people also love to get attention themselves. So you can entertain them and give them attention at the same time. That can be an amazing business. And Instagram, Facebook, and the rest of social media does exactly that, right? That's why those businesses have become such, monsters over the last decades. So what tools is COVID going to introduce? We're sitting on one of them, obviously, right now. We're talking on one of them. What is going to be the level of adoption of these the different tools? Zoom obviously is kind of the most top of mind one, but going forward, right? And so I didn't know exactly how I wanted to kind of put like an actual number on the idea of contrarian, put some actual criteria on that. And so there's a bunch of different valid ways you could define it, but I settled on screening my investment universe for stocks that had underperformed the S&P 500 since January 2020, right? And also had compressed price to sales or price to book ratios over the same period, right? And I came up with 2 companies and talk briefly about them. I'm having a little trouble with Google, so I actually do not have my slides available, but I will put the links to the IR pages of these companies, I guess, in the chat. And then, or Ben, I don't know if you have any other ideas for that. And then maybe I could try to log into Google after my turn is over and try to maybe share my presentation in the chat. Yeah, does that sound good, or Ben?
Yeah, sounds fine. Just if you can do it by memory, that works just fine too.
Yeah, for sure. I'll do my best. So the first one is a branded food products company from Brazil called Camil Alimentos. My Spanish is all right. My Portuguese is non-existent. So if I mispronounce any of these, names, don't hold it against me. So first of all, the company has a bit of an interesting history. It grew out of a family farm. The Cotillero family owns and still owns 70% of the business. Originally, the current organization on the stock market was originally a joint venture with TWC, and then they sold out, and it was Warburg owned the other part of it for many years. And then when they IPO'd in 2017, Warburg sold out of their portion. Currently, the largest shareholder, other than the founding family, is Franklin Templeton, who owns 7%. They are either the number one or the number two packagers of rice, beans, and canned fish in most of Latin America. So most of northern Latin America. That's Brazil, Peru, Uruguay, and Bolivia. And they are they're a serial acquirer. They've bought a bunch of brands over the years. So they currently, for instance, they have a government granted monopoly on rice production in Uruguay. So they have a guaranteed profit margin there. Unfortunately, that's actually been a negative over the last years because they also have they're limited on price increases by the contract, and so they've run into shortages. So the margins are the same as they've always been, but revenue is actually down because sales are down because of shortages. Yeah, so they have a dominant position in those areas in most of northern Latin America, and they also they have partnerships with Walmart and most of the other big box stores down there, which so they sell branded versions of all of those commodities. And I'm sorry, I'm doing this from memory, so it's a little bit, but it's their margins are pretty impressive, and they're also selling at like 6 times free cash flow. So it's an opportunity that you would not get in the U.S. market, and yeah, they have a bunch of iconic brands, a bunch of brands with 40 to 50 to 60% market share in the markets that they operate in. The other business that I want to talk about is probably it's one of my favorite investments. It's maybe not one of my best ones because I've owned it for forever, and it's the returns have not been, but it's Contrarian, and I think it's one of my most fun investments, so I wanted to talk about it. It's a company called Reinet Investments. Let me spell it for you: REINET Investments, SCA. It is actually, maybe some other value investors in here have looked at it, but it is actually it's a remnant of the split up of Richemont in 2008. So it is before 2008, the Rupert family owned about I think at the time it was over 10%, but I could be wrong about that. But anyways, they own some significant portion of British American Tobacco, and Reinet was spun out specifically to house that position. So when it started in 2008, that was the only position that they had. It was just a holding company for that 10% ownership of British American Tobacco that the Rupert family held. They have since every year worked to diversify the holdings of the company, selling British American Tobacco shares and buying shares. The biggest thing is they own a company called the Limited Pension Insurance Company, which is a UK pension insurance provider. They own 50% of that, which is another 6 billion euros. And then the rest of the diversification which amounts to about 15% of the NAV of the holding company, has gone to mostly mediocre private equity investments, but you win some, you lose some. Yeah, it's currently selling at like a 50%, not quite 50%, but about a 40% discount to the NAV of the marketable investments in the holding company. So it's pretty significant discount. And they buy back shares every year, so the discount's been closing like slowly over time, but not very fast. But anyways, I just love that company. Fun. And that's it. Do we have any questions?
Sure, Jeff, I have a quick question on the holding company. One of the
For sure.
things I always see with holding companies is that they often trade at persistent discounts to what you would think of as its intrinsic value or NAV.
Mhm.
Is there a catalyst here? Do you need to have a catalyst? Do you feel like you need anything like that to make money, or do you think you can just, do they need to divest or spend something, or can you make money otherwise?
I mean, so I think that if you want to hold this, if you want to be long this company, you need patience, because I've held it. It's not a huge holding. I mean, to be honest with you, it's actually hard to build a huge holding because this thing barely trades at all. So it trades in, it's registered on Euronext, so it trades in Amsterdam, right? That's like probably the easiest way to acquire the shares. But it trades, 10,000 shares a day at $17 a share. So the volume is like, you know what I mean? Nothing. Yeah, I mean, basically the return of value is either from the return to fair value is either from, continued share buybacks, I mean, if you bought a share today, you're paying 17 euros, by the way, I apologize, 17 euros a share. And the value of just the British American tobacco holdings is like $21 a share, so you're buying it at a discount to just British American tobacco stock, the publicly traded stock. So yeah, we'll see. I mean, the Johan Rupert, the guy who runs it, he gets asked every 6 months, how are we going to return this to fair value? And he just counsels patience and says that they're continuing to diversify and continuing to run their share buyback programs, and yeah.
Got it. Well, thanks so much. Those are two really interesting ones that my guess is no one's ever heard of. So very, contrarian takes and very, out there ideas. Thank you.
The Camino Alimentos, one of the reasons that the opportunity exists is that there's no ADRs. So you have to invest directly in Brazil.
Got it. Okay, great. Thanks so much. Now we're gonna move to Nick. Nick, you ready to go?
I think so. Let me just share my screen. Okay. Everyone, my name is Nick Nejad. I'm the Director of Investment Research at KC Wealth Advisory. We are a wealth manager based in Los Angeles, managing $370 million in assets under management. We're a full service shop. We do everything from financial planning to investment management, and my expertise and focus is on the investing side. We have individual equity and fixed income models that we apply to our clients with some customization for their individual circumstances and needs. My contrarian presentation today is titled Preparing for a Travel Surge. So pre-pandemic, travel was viewed as one of the great global trends, and there was a long and fairly resilient history of 5% growth in metrics like hotel revenue and air passenger volumes. And then COVID hit and impacted all of it. Preparing for a travel surge. Slide 2. All right. Pre-pandemic, travel was viewed as one of the great global trends, with a fairly long and resilient history of 5% growth in metrics like hotel revenue and air passenger volumes. And COVID hit and really impacted all these industries in pretty unprecedented ways. So much so that even now, I would say the outlook is still somewhat murky. Recovery is still somewhat far off. General consensus seems to be forming around this. COVID is going to take 2 years of growth away from the old travel trajectory, and then travel is going to resume growing at the old underlying rate. And you can see one example of this here, which is the IATA forecast for global air passengers, and basically where there was a trend line shifted down 2 years ago. Now we say, what if we approach this problem differently? And instead started with, well, what do we actually feel pretty confident about? And what are we more sure about of COVID's lasting effects, and how might those affect travel? And when we approached it that way, we actually came up with interesting insights. For example, we do think remote or hybrid work models are here to stay. And alongside that, we think routines and work schedules for people are going to become more flexible than ever, especially amongst the highest earners. And that's going to become an important part of this. Third, people are more dispersed. So think of all the people who moved from major cities to buy homes in the suburbs. Think of businesses who were willing to hire outside their local region. Just before this, Airbnb recently reported, and I couldn't help but glean some of the numbers from it. But here's what they said in their earnings report. Long-term stays, defined as stays of at least 28 nights, remained our fastest growing category by tripling. Airbnb survey data indicates that people plan to continue to travel and live this way, with 81% of our long-term stay guests in Q2 2021 saying they plan to book another long-term stay in the coming year. They also mentioned non-urbans growing faster than urban, and that over 50% of their bookings are at least 7 nights. So I think a lot of this kind of supports this idea of, hey, remote workers are able to disperse a little bit more and also take advantage of some of these travel things. The fourth one on our list is, we say digital has gained share of everyday experiences. What we're basically saying there is, a lot of in-person interactions we had in our everyday life have now become more digital. So for example, grocery shopping, meeting in the office, et cetera. So there's a void of in-person contact we less now post-COVID. Finally, some of the industries hardest hit, including in travel, have been forced to cut costs, rapidly adapt to a changing environment, and become much more efficient. Now, when we look at all of this, we could argue that each actually is a long-term tailwind to the overall travel demand trend, and more specifically, leisure travel demand. And so that is our contrarian take. We think travel is coming back, and that'll grow faster over the long term than if COVID never happened. Historically, travel, again, was a very strong growing industry, well correlated to things like income, GDP, and demographics. Again, we think this might all lead to maybe a step change materially higher. Now, what's interesting is you're starting to see some signs of it already happening. And so, we mentioned already the Airbnb info before, but for example, leisure room nights in hotels in the latest quarter are up 15% versus 2019. And think of this as traditionally, a metric that would grow maybe 1 or 2% year over year. So leisure room nights are up a lot. Meanwhile, some of the business and group travel things that people are most worried about, and rightfully so, are surprisingly coming back faster than you expect. So by October, they expect group bookings in hotels to be about 80% recovered. And, Delta in a recent call expected 60% recovery in domestic corporate travel by September. Last one here that we think is kind of interesting. Hotel occupancy at the end of July was 70%, down about 6% from 2019 levels. Why we find that particularly interesting is this slide. And honestly, this applies for all of them. This is all despite the fact that, according to surveys, half of people still do not feel comfortable traveling, and half of people still don't feel comfortable staying in hotels. So in an environment where, a good segment of the population still is not, back in a traditional vacation travel setting, demand seems to increase materially. Oops. If you want another green shoot to this thesis, look to China, where they did a very good job of containing COVID. Basically, the short summary here is travel's up across the board. Flights are up, passengers are up, hotel stays are up, business hotel stays are up, even group bookings are up. So, there is some other outside green shoots here. Here's some of the factors working for and against this idea. So 75% of trips are for leisure, and leisure is booming. By the way, it's roughly the ratio for air passengers is about 70% leisure as well, although the revenue on business customers are higher, and that's going to be another theme you're going to see play out here. 2, most employers and employees expect to adopt at least some form of remote or hybrid work model. There's a variety of surveys, but they almost all point to some kind of, majority adoption. Finally, and this is, I think, a really important part of the overall thesis here, travel frequency is greatest among workers most likely to benefit from the aforementioned trends. And basically what we're saying there is the top 20% of wage earning households spend 10 times as much on travel than the bottom 20%. And those top 20% are now the people who have always had the means, but now also a little bit more flexibility to be able to materially increase their travel expenditure. What works against our thesis? 1, some amount of business travel is never coming back. I mean, I think that's pretty much a given. 2, COVID hasn't been solved yet. We're optimistic, but again, this could take a shape that we're not sure of. And 3, the current numbers might be, maybe we're misinterpreting these, we're reading too much into them. Maybe this is just all a temporary rebound because people have been locked up for so long. Okay, so how do we play this? Our pitch today is a company we own and one I followed for the better part of a decade now, and the company is called Aircap. Aircap is the world's largest aircraft leaser. It is also undergoing an acquisition right now of the number 2 player, which should complete by the end of the year, of GE Capital Aviation Services. And what you'll have at the end of this is a firm that has about 18% of the global leasing market of aircraft and 9% of the total aircraft market in the world. The next largest competitor will only have about 5% share and be about a quarter of the size. Why do we like it? Well, it's a travel dependent stock, but as a travel dependent stock, it's also a couple of layers protected from, just straight airline profitability. They like to say that as long as an airline is cash break even, we're made whole on our long-term leases. And if we think 70% of passenger volumes may see an uptick because of this trend, that should help offset any fall in long-term business travel. 2, it's cheap. It trades at 7.5 times forward earnings. It's at 0.75 times standalone, written down book value. But here's where it gets really interesting. We've just gone through a period where, the primary competitor for Aircap and other aircraft leasers, which has historically been airlines just buying their own aircraft, is now kind of off the table because balance sheets are in terrible shape at airlines. For example, Delta started pre-COVID with about 10 billion in net debt. They now have 19 billion in net debt. And, it's going to be very hard for any airline in the world to justify cutting a check on new aircraft when, they have a lot of other balance sheet issues to fix first. So leasing is going to gain market share. At the same time, never before has the landscape been so consolidated where you have one player at about 18% and another player at, the next largest player at about 5%. And so we think Aircap's going to come into this business with, a strong position with advantages in purchasing power, information, and global reach. And, one extra point just to note about that and leasing businesses in general is, small drivers of change in these businesses on the asset front lead to, much bigger drivers on the equity front. So if, for example, you thought this was originally a cost of equity business, and it by and large has been, if you're able to, lease your aircraft for 1% better rates, or you're able to get 1% better utilization, or you're able to purchase aircraft for 1% cheaper, it drives meaningfully more improvements in ROE. Now, in addition to all that, this is a leverage play on our air travel theme. And so, if air travel does boost back stronger than we anticipated, we think they'll be a beneficiary. Interesting to note that it's actually generally a pretty liquid market. Right now, maybe less so, but over the last 4 years, they've sold about 20 billion of aircraft, largely for gains. And as perspective, the combined balance sheet is going to be about 70 billion. So, you have the ability to monetize and maybe close discounts if that's how the price is still reacting in terms of stock price. It's also a serial acquirer. So from 2015 to, now they've repurchased about 40% of their shares. Really quickly, last slide, risks. This is not an industry unfamiliar with trouble. There was some high profile bankruptcies in the 90s. And there's significant leverage, which provides upside, but it also, entails some risk as well. And it's cyclical and a high beta stock. for us, the key point here is just size the position accordingly. And with that, I'll take questions.
Nick, that was really interesting and obviously well thought out and well researched. My question for you is, so how are you guys thinking about where that incremental travel dollar is going to be spent? Because I think you could also see, as opposed to people flying either domestically or internationally, just taking more day trips, taking more, whatever, going to Disneyland by car kind of thing. How is that? How have you thought about that relative to, just a big jump in air traffic?
Well, look, I think it's an all-encompassing theme on travel, and we're also looking, past, well past 5, 6 years, 7 years, when COVID is well past our memories, and we are just looking ahead to what everyone wants to do with this new amount of freedom to their schedule and everything else. And at the same time, with the less, in-person interactions we get in our day-to-day lives as well. And so, I think it's kind of like a rising tide lifts all boats. I think in the meantime, there's still some more hesitation in terms of air traffic. And for example, there's huge barriers in terms of international traffic still. But assuming this all gets lifted and we move past this, we think it's basically going to benefit, most things, with the main exception being businesses very tied to higher revenue business and corporate business, I guess that's the way to put that.
Nick, what do you think the right earnings multiple is for an equipment leasing company? Like 7.5 seems cheap. Should this be at 15 or 20 or like what?
Look, it's interesting because if you look at Aircap's history, it's traded at basically 9 or 10 times. So maybe 7.5 is slightly cheap from that perspective, but rightfully so, given the fact that, international travel is still, a fraction of what it should be. And there's all these major uncertainties surrounding it. What we think really makes this particularly interesting right now is just the dramatically different landscape compared to any other situation you've ever seen before in terms of, again, across the board, airlines are kind of out of the market of buying their own aircraft. Like, it's going to be so hard to convince board of directors to splash on, 100 jet order. And historically, the only thing competitive with purchasing planes, with aircraft leasers purchasing planes has been like one of those major orders where it's customized specifically to one OEM and it's like a huge outlay. If that's off the table, you now have a new environment where, Aircap has much better purchasing power than your incremental buyers. And so it does change the landscape a little bit. But it has historically, again, been a levered business, 10 to 12, 13% ROE. As you've seen here, like there's the potential for global conflicts or things to, get in the way of this. But we are very excited about this changing landscape and what it could mean if this deal goes through in this environment.
Great, Nick. Thanks so much for all that. That was, really well researched. Thank you. We'll move to my colleague, Andrew Leaf.
Great. Well, thank you, Ben and Bobby, for having me. My name is Andrew Leaf. I'm a research analyst at Cove Street. I work with Ben. I can be reached at aleaf@covestreetcapital.com if you have any questions. So the topic I have brought up for today is the B2B trade show industry, which has been one of the hardest hit in COVID for obvious reasons. What I'll discuss today is one, why I like the business itself. Two, then I'll take you through what's happening in the industry today. And then I'll talk about a sort of special situation stock I personally own that I think is pretty interesting. So starting with why these are great businesses, they're extremely asset light. Most of the equipment and booths that you would see at a normal trade show are owned by the venue or a third party and not by the actual trade show owner themselves. A lot of these trade shows are actually owned by like trade associations, and so they're really just customer lists and they outsource putting together these events. The joke in the industry is that when you acquire another trade show, you're really just given a list of emails. So you pay millions for that, and then and that's really it. So these businesses are also highly cash flow generative. You collect revenue ahead of the events, sometimes up to a year out. So you get some great deferred revenue, and you have very high visibility into next year's revenues because of that. And for all those reasons, especially the cash flow generative aspects of the business, a lot of private equity firms own these, but there are some public equities as well. On top of that, when you look at the just economics and unit economics of an event, it's pretty recurring. You get like 80% for exhibitor retention rates at some of these companies. And so there's some recurring revenue aspects to it as well, which is nice. And the incrementals on the business are fantastic because you're running a massive show. And so the added exhibitor that you get could give you up to 30-40% additional EBITDA margins. But then obviously the decrementals are horrible as well, because if you lose a exhibitor, then a lot of that drops to the bottom line if you're running a same sort of scale or size scale event. So what's happening in the industry now? You can refer to Informa. They're one of the largest publicly traded businesses, one of the largest publicly traded companies that own a lot of B2B trade shows. They have a lot of good information. So if you actually just look sort of at the macro, and I'm going to compare US versus China because I think it's actually a really interesting comparison for B2B trade shows. In the US, domestic travel is not fully recovered to 2019 levels, while in China it has. And when you look at the sort of daily case count, it's anywhere from, it's close to 19 per 100,000, where in China it's less than 1. So clearly in China there has been, COVID's been better handled, and there's less pervasiveness of the virus, and so people are more comfortable going to these events. And so if you look at the micro level of what this translates into in China, actually, and this is if you look at the China Beauty Expo, and Informa releases this information, they had this event basically generated the same amount of revenue in 2021 as it did for them in 2019. So that's fully recovered. The number of attendees were 135,000 in 2019. It's about 125,000 in 2021. So pretty good recovery there. When you look at a event in the US, World of Concrete, you're looking at in 2021, they had 35% of revenues as compared to 2019. So clearly this industry in the US has not recovered and has been doing quite poorly when compared to China. So looking ahead, as I mentioned, you have extreme high visibility into the next year's events because you collect bookings so far ahead. 2022 is in China for the same Beauty of Expo event I was talking about. It's looking at 100% of 2019, so similar to 2020, if not a little bit of growth. And the World of Concrete's looking at 60% of 2019 compared to 35% in 2021. So some recovery, but we're still not fully there. Again, those numbers are pretty good indications, though, that we're seeing a recovery in the US. So how this translates into sort of the stock idea I have, the company's called Emerald Expositions. It's a small cap publicly traded trade show company, only US based. So if you look at their financials, clearly have been hit quite hard with COVID because they're mostly US. 2019 revenues were 360 million, LTM were 50 million or 48.6 million. So some really, obviously really hard hit, and there's a lot of decrementals there. What's interesting about this situation is, one, so it probably would have gone bankrupt, but it was 70% owned by a private equity firm. And so they did a private placement and basically re-equitized the business with a preferred equity. So if you're going to look into the stock, make sure you use the fully diluted share count. It's about 71 million shares outstanding, but fully diluted, it's 162 for that preferred because it can convert into common equity. And what's really interesting about this stock is that Emerald Expositions actually had a pandemic rider, insurance rider for the company. And so to date, they've collected about, and this is, with the diluted share count, maybe call it an 800 million, enterprise value business. They collected 124 million in cash, about 77 cents per share. It's a $4 stock already in insurance recoveries. The insurance companies stopped paying them because it was a massive amount, but they still are suing for about 120 million more, and it could even be higher than that, depending on how the rest of 2021 looks. And so if you just model out at some horrible decrementals, the math I'm getting is basically you get a $4 share price if the US event industry only recovers at 60%, and just stays at that rate and sort of flatlines or grows a little bit from there. But anything above that, which I think is a pretty decent bet, would have massive sort of incremental value to the share because they have great incrementals, as I mentioned earlier. And so 75%, I'm getting about 75% recovery of 2019. I'm getting about $5 a share, and 90% you can get up to $8 or $9. It's a $4 stock now. So thought that, considering they're not global, but you can get a sort of look at what's happening globally by looking at their global competitors. I think it's an interesting sort of trend that you might now see recovery in the US a few years out. So with that, I'll leave it to questions.
Andrew, sticking with EEX. through it all. No, I mean, it's obviously COVID was not on our spreadsheet when we first looked at this company. So it's been a rough ride there. So I'll start off. What I guess, as you think about the recovery, right? There's it's not just about the number of shows. It's not to some degree, there's a mix of, okay, well, there used to be 2, whatever beauty shows every year, and we're going to consolidate to 1, or there's a bunch of peripheral shows that you just can't actually believe that people used to travel to because how, why is that even a show? How are you thinking about that dynamic of looking at aggregate numbers? Yeah, saying 60-70% makes sense, but if you dig deeper and you say, well, why do some of these shows exist, or why do they happen twice a year? How have you incorporated that thinking?
That's a great question. And so in particular with Emerald, why I like them in particular is they have sort of the largest shows in their categories. These are the best known in the industries. A lot of these are acquired through roll-ups or whatnot, and so the private equity firm was acquiring the largest shows. And so again, it's impossible to tell until it actually happens, but they may actually benefit from some market share growth as the smaller shows in those categories can't exist anymore.
Are they doing digital shows? I've seen events. I mean, obviously we're doing this digitally, conferences, or some of them are doing digital stuff. Are they doing that, and is that a potential growth driver for them?
Yeah, they're transitioning to digital. They had some shows that were digital this year and last year, but it's just a lot less revenue for them. And so it might be an interesting incremental revenue once things recover, but it's hard to foresee how much incremental revenue that would build on top of the physical business, but who knows at this point.
Andrew, I'll just say that 3 of my portfolio companies are at the same conference right now. So it's very good that that people are going back and doing business again. And I have been advising my portfolio companies that whatever they're saving on rent, they should be reinvesting that into conference attendees and to sending more of their team members than they would have otherwise to the big conferences in their industry, because you need FaceTime with customers. You probably don't need, even to sell a $100,000 or more enterprise software contract, to ever get on a plane again. For most of my portfolio companies, they don't need to do that, but you still want to see your customers. And if all your customers are going to be at one conference, then you've got to send every single person you've got there, because your top salesman and your CEO are not enough to cover everyone there, and that's the only chance you're going to get for that.
That's great commentary, and the optimistic view here, and some people hold this view, I'm waiting to see obviously what happens, is that with less commercial real estate and, less people having, less office space and people leasing less, amount of space, these conferences might actually grow and overall in the US because of that exact reason. It's a great meeting place where you're not going to come to someone's office anymore because everyone's working remote or distributed, but you can all meet up at a conference and sort of
Yeah.
kill two birds with one stone. And so that's great, and that'd be great to see for the industry.
Yeah, that's exactly what I'm expecting to happen. I'm about to go to a conference myself that I prepaid for 2 years ago that got postponed about a little bit by COVID, and so that conference organizer is going to turn a 2-year deferred revenue line item on their balance sheet into actual revenue on their third quarter income statement right now. So I'm happy about that.
That's exactly how that works. Exactly. Yeah.
Andrew, that was great. Very, very contrarian space where I think people thought that industry had, literally didn't have a future. So that's a good one. And we will close with Adam Gold.
Sorry, good afternoon. My name is Adam Gold. I'm the CIO and founder of Katam Hill. We're an RIA in Los Angeles, California. I've been investing for over 20 years professionally, even more. My first memories are AOL dial-up trades in middle school when I was home sick. And so I love investing. I love technology. I love innovation. I've invested public, long, short globally, as well as early stage venture and late stage growth on the private side. I take a private equity approach to public markets, so very concentrated. We're today 100% focused on individual companies, and we try to be extremely long-term, decade-long holders. I have 2 types of account strategies we run as separate accounts today. Deep Growth Plus, that's for margin taxable accounts. That's compounded at 27% net of 1 in 10 since 2009. And our deep growth accounts are long only retirement. That's done 25% a year since 2010. The COVID contrarian theme today is the YOLO genie is out of the bottle. So you only live once, as Cambridge Dictionary says. It means you may do things that are more enjoyable and exciting, even if they're silly or slightly dangerous. So the return to normal versus new normal paradigm that we've all talked about, this pendulum, not always sure where it lies at any given day in the market. Some days the Dow's up and the Nasdaq's down, or vice versa. But generally speaking, we think with Delta and other variants in the future that work-life balance has changed and you can live, work, or play from anywhere. So similar to some other speakers. And particularly this theme around deurbanization and the move to suburbs and rural areas. And so that means that new car buyers who historically may have bought more smaller size sedans or crossovers are going to be in the market for more fun, adventurous pickup trucks and utility vehicles. There's also a massive trade with electric vehicles, as well as the infrastructure plan that the new administration is talking about. So we think there's a decade-long opportunity here. So the company we're going to talk about has a 100-year history. It's new to the portfolio since Q4 of last year, but there's a lot of elements we like to the story that make it exciting. Mostly, there's a new CEO who's extremely competent and technical. The last CEO came from an outside. It was in an industry that was not very well versed, and the company did not do well. It was also run as a family business for a lot of generations. And so the company we're going to talk about is the Ford Motor Company. This is a picture from their recent earnings call of their truck lineup. And so they're leaders in trucks. Stock price is just under $14, 55 billion market cap. They'll do about 130 billion of revenue this year with a profitable 2.5% net income margins. And they recently raised their free cash flow estimates for the year to 5 to 10 billion. The balance sheet has a lot of debt with Ford Credit, but if you actually look at the corporate auto business, it's about flat. So 56 billion enterprise value on the revenue base is about 0.4 times. And that compares to GM, which is around 0.6 times, or Tesla, which I've owned for 10 years, that's at 14 times. That I can never explain to people on valuation, but it's about innovation and being early in a market. So what I love about Ford and why we're continuing to add to the positions, despite the supply chain issues, as well as some of their own manufacturing delays around some models, which news came out today around the Bronco. But supply issues can be fixed. Demand issues are very hard to fix. And so we like to have companies that have supply issues rather than demand issues. So on Ford, it's 5% global market share. What's really important is they're #1 in trucks. They have a 35% market share in the US. And they, of their total volumes year to date, over 50%, so 53% of those units are trucks for their total mix. That compares to GM, which is about a third trucks, and Dodge, which is Chrysler, now Fiat Chrysler, which is rebranded Stellantis. Consumers don't even know what that means. It's a multi-continent merger. But anyway, that Dodge is about a third of the business. So they're more than 2 times over-indexed to trucks relative to the other US car companies. And most importantly is product excitement, right? And so innovation around electric vehicles. And so EV share is 4% today. It's doubled the last few years from 1 to 2 to 4. We think it's on its way to 40% plus, call that 10x growth, maybe even more over time. And so that's really important because that drives excitement, and excitement drives higher pricing, and higher pricing drives better margins. So what the company's done is they've simplified their product lineup. And so they really focus now on more iconic brands. They brought back the Bronco. They have the Maverick, which is a lower priced car, truck rather, on the right, the yellow car. They have a Mustang, which they've done a crossover EV. They'll likely have a convertible EV in the future. They have the Lightning, which is their F-150, and they have a Ranger. So their entire lineup's going to go electric. Another change to the business, which is important, is more of made to order. Given they have a massive backlog of new products, 25% plus of their current backlog are custom orders from customers. And given they have long lead times, they can actually build more cars that are appropriate for customers, as opposed to the historical car model. Build a lot of models, ship them to dealers, and have them sit on the lot for a year, and then have to really incentivize dealers through promotions to be able to move those cars. So this is a transformation in the industry because of the sort of demand supply issue we're seeing, plus excitement around cars. And so I think with that, they're calling it this Ford Plus strategy around connectivity. This will all lead to better margins and better free cash flow. So we look out a couple of years, we think they can earn around $2.50 a share, 10 times earnings, which is quite low for overall growth companies. For car companies, maybe are on the higher end, but we think it's going to be feasible with the growth they're going to have. That gets us to $25 a share. The stock's around 14, so call it around a double in the next, we think, 12 or 18 months. And so I think 100 billion market cap for an iconic American car company is right around the corner. So that's my idea for the day.
Adam, I don't have a question. I will just say that I have never wanted a car more than I want the new Bronco.
Yeah, my wife had the deposit down. Unfortunately, they just can't make enough of them. The dealer locally has already sold out 600 for the entire year. If they originally were going to get 250, they asked for more. It's all, and this is basically they cannot make enough of these cars. So that's the kind of problem you want to have, for a business. You don't want any problems, of course, but demand problems are very hard to solve. Usually you solve them with pricing drops or incentives. And they have the opposite problem, which is really great. And they also have a really nice roadmap here in the next few years, F-150 next year, and then going forward, the Ranger, et cetera. So they just have a very slow, steady cadence of new product introductions, which is what you like to have when you're looking out 10 years for a business, saying you don't want everything in 1 year. You want to have something that's slow and steady. So yeah, we think the Bronco looks very cool.
Adam, given that they're moving, this is a whole new world for them where their larger vehicles are going to be electrified. Why do you think Ford will be a winner versus GM or Toyota or Dodge in terms of making a vehicle that the type of person who wants a truck wants to drive? It just seems like, the first generation of anything can be a little scary, as a consumer. I'm wondering why you think technologically or management or partnerships they've done, like why them?
I think it's about their leadership so far, so why do they have 35% share of trucks, right? So it's the history, the legacy, it's innovation, and it's sort of reputation. People are very brand loyal. I think with cars, people, the largest market share for any car company is 10%. Really, there's not, you've never really gone over it. I think why Tesla is currently at 700 billion plus market cap is they dominate EVs. They're around 2/3 market share. So there's never been a car company with this much market share. So one is the answer is not everyone, doesn't have to be a winner take all market necessarily, given that the auto industry itself has been, has dozens of players, and that all may consolidate down. But I think with Ford, what's important is when I looked at this last year, at one point, Nikola was worth more than Ford in the market last summer. And Nikola had 0 products, 0 revenue, and we found out, they fraudulently lied about a lot of things. Rivian's going to become public soon. Similarly, in terms of production, they've never made a product to market, and it's about a $60-70 billion private market cap. So I looked at all these EV companies. There's lots of them. Lordstown, there's several of them, and it felt like none of them have ever made a car. They have no scale, they have no manufacturing, and their market cap prices were all, turns out, quite astronomical. So when you look at Ford, I started buying it around $25-30 billion and said, well, this company has millions of volumes. They have manufacturing capabilities. They have an incredible brand. They just have to be able to figure out if you'll get batteries and really swipe out, some of the powertrains and other items. Like, it seems quite possible for the incumbent, the well-established brands to be able to convert some of their cars to EV, as well as continue to sell combustion engine, right? So they even talked about this recently, like they're going to continue to sell in rural markets where there's not electrical grid, capabilities. They're going to continue to sell those cars. And so you would think those cars are going to be able to continue to fuel profit margins. And that's something that new car companies won't have, right? So they've got this cash cow business to fuel new product segments, which I think is quite exciting. Unlike Tesla, which has really used capital market funding, as a non-profitable business to grow, Ford has that ability to do it. So I don't think GM stocks work quite well, actually. They've been very vocal on the shift to EV. Their stocks performed great so far. But I think actually relative to Toyota and others, that these brands around Bronco, Maverick, I think these are as similar to Tesla or Apple as you can get, where you simplify the product line down, you make it quite simple for consumers, and it's about the Bronco, not about Ford. And I don't think that's the case for a lot of other car companies, where it's more of I like Mercedes for Mercedes, and there's 15 different versions of that car. So I think their ability to recognize that they've simplified the products to brands and let's sell brands to consumers is quite powerful.
Great. Anybody else have any other questions? All right. So I'll just finish with a few closing thoughts here. So we hope everyone enjoyed this discussion. We're very happy to be able to share the 10K Club for the first time with a broader audience. If you had any questions or comments for the panelists, please find a way to reach out to them. You can always contact me and I can put you in touch with them. But most of all, thank you, Bobby and SNN, for having us. So I think this has been an incredible discussion. I think what an eclectic group of companies and contrarian perceptions. It's what I really love about this group, is that there's just, you never know what you're going to hear. So with that, we're going to sign off, and till next time, thanks everybody.
Thanks, everyone.